First Solar Inc., trading on the NASDAQ under the ticker symbol FSLR, finished its most recent trading session at a price of $274.34 USD. As today is Saturday, January 3, 2026, the market is currently closed for the weekend, but that price represents a significant upward move of 13.11 USD or 5.02% from the previous day's trading activity. This jump isn't just a random fluctuation in a volatile sector. While many investors were distracted by the usual headlines surrounding Tesla stock or the latest hardware cycles affecting Apple stock, First Solar quietly established itself as a cornerstone of the infrastructure required to power the next decade of computing. If you look at the recent volume, there's a clear appetite from institutional players who are treating this company less like a cyclical utility play and more like a high-growth technology provider. The immediate insight that most people are missing is the aggressive shift in who is actually buying these solar panels. We are no longer looking at a market driven solely by residential rooftop installations or small-scale government projects. Instead, we are seeing the emergence of the data center energy squeeze. Big tech firms are realizing that their massive expansion into artificial intelligence is limited by one thing: power. This has turned First Solar into a strategic asset for companies that typically dominate the holdings of a Schwab Intelligent Portfolios account. The common expectation among retail investors is that solar companies are perennial underperformers, forever waiting for the next round of government subsidies to stay afloat. The reality is far more robust for First Solar specifically. Unlike many of its competitors who rely on silicon-based technology and supply chains rooted deeply in China, First Solar uses a proprietary thin-film semiconductor technology. This vertical integration allows them to bypass the geopolitical risks that often plague other firms in the space. When you use an individual brokerage to pick stocks, you often look for a moat, and First Solar has built one out of cadmium telluride. While the broader market might be looking at the next move for NVIDIA stock to gauge the health of the tech sector, smart participants are looking at the energy backlog. First Solar recently reported a contracted sales backlog of over 50 gigawatts, valued at roughly $16.4 billion. This provides a level of revenue visibility that stretches out toward 2030, a rare luxury in any industry. This gap between the public perception of solar as a risky green bet and the reality of First Solar as a highly profitable, backlogged industrial powerhouse is exactly where the tension lies in its current valuation. If you are managing your own funds through an online investment platform or utilizing Fidelity for your retirement planning, you have likely noticed that the solar sector often moves in a pack. However, First Solar has begun to decouple from the group. While companies focused on residential solar have struggled with high interest rates and changing net metering laws, First Solar's focus on utility-scale projects has insulated it. The recent 5.02% gain is partly a reaction to Alphabet's massive $4.75 billion acquisition of Intersect Power, which is a major customer for First Solar. This deal effectively guarantees that a massive portion of First Solar's production will be funneled directly into the energy grids supporting Google's data centers. This is a massive endorsement of the technology and a sign that the biggest spenders in the world are choosing American-made thin-film modules over cheaper silicon alternatives. When you see this kind of institutional commitment, it changes the way you approach self-investing. You start to see that the demand is essentially inelastic for the next several years. Institutional activity has been particularly telling over the last few weeks. We have seen a surge in call option demand, suggesting that big players are betting on even higher prices as we move deeper into 2026. This isn't just speculative fervor. The company is currently benefiting from the Section 45X tax credits, which provide a direct financial incentive for every watt of solar capacity manufactured in the United States. For a company that is aggressively expanding its domestic footprint with new facilities in Alabama Alabama and Louisiana, these credits aren't just a bonus, they are a fundamental driver of margin expansion. If you are using SoFi Invest or a similar SoFi trading platform to track these movements, you'll notice that First Solar's gross margins have consistently outperformed expectations, often hovering in the 40% range. This is unheard of for traditional manufacturing and speaks to the efficiency of their fully integrated process. They aren't just assembling parts, they are making the semiconductor material from scratch. When people look for investment help, they are often told to diversify, and while that is sound advice, understanding the specific catalysts for a leader like First Solar is essential for anyone doing online investing. The company is currently targeting a global annual nameplate manufacturing capacity of over 25 gigawatts by the end of 2026. To put that in perspective, they are essentially doubling their scale in a very short window. This expansion is happening right as the United States is tightening its trade policies. New tariffs on solar components from Southeast Asia have made imported panels more expensive and less reliable in terms of delivery dates. First Solar, being the only major U.S. headquartered manufacturer that doesn't rely on Chinese silicon, finds itself in a position of extreme pricing power. They can offer pricing and delivery certainty, which is a phrase management uses frequently to distinguish themselves from the competition. In a world of broken supply chains, certainty is worth a premium. Let's talk about the business model for a moment because it is the bedrock for why the stock is behaving this way. Most solar panels you see are made of crystalline silicon. They require high-purity polysilicon, which is energy-intensive to produce and mostly comes from overseas. First Solar's thin film modules are different. They use a layer of cadmium telluride that is about 3% the thickness of a human hair. This makes the panels more efficient in high temperatures and humid conditions, which is exactly where most large-scale solar farms are built. Because they control the process from start to finish, their carbon footprint is significantly lower, and their energy payback time is faster. This makes them the go-to choice for ESG-conscious funds that you might find through Fidelity Wealth Management or within various Fidelity ETFs. It also makes them a favorite for long-term holders on platforms like Robinhood, who are looking for a company that can withstand the test of time and shifting environmental regulations. Comment below how many shares of First Solar Inc. you currently hold in your portfolio, and let me know if you think the current price is a fair entry point or if you're waiting for a pullback. Engaging with the community is one of the best ways to refine your investment strategy and see how other retail traders are positioning themselves on investing sites. Looking at the broader macroeconomic picture, First Solar is not entirely immune to pressure. Higher interest rates generally make large-scale energy projects more expensive to finance. However, the company's strong net cash position, which was reported around $1.5 billion in the last quarterly update, gives them a massive advantage. They don't need to go to the debt markets to fund their expansion. They are essentially self-funding their growth through their own cash flow and the tax credits they receive. This financial stability is something you rarely see in the renewable sector. Most solar companies are drowning in debt, making them risky bets on an interactive brokers platform during a high-rate environment. First Solar is the exception to that rule, behaving more like a mature industrial giant than a speculative startup. The future outlook for First Solar is tied to two main scenarios. The first is the continued expansion of the U.S. domestic manufacturing base. If the company can successfully ramp up their fifth factory and maintain their high yield rates, the earnings per share could see a dramatic increase by the end of fiscal year 2026. Analysts have already started raising their targets, with some looking toward the $300 mark if the momentum holds. The second scenario involves the potential for policy shifts. While the current administration has been very supportive through the Inflation Reduction Act, there is always the risk of legislative changes. However, First Solar has positioned itself as a job story in states like Ohio and Alabama, which often provides a level of bipartisan protection. Even a change in leadership might find it difficult to strip away incentives for a company that is bringing high-tech manufacturing back to the American heartland. When we compare First Solar to other high-profile stocks, the valuation actually looks somewhat reasonable. While the P/E ratio might seem high at first glance compared to a traditional utility, you have to look at it through the lens of growth and the contracted backlog. When you buy a share of First Solar on the Robinhood app or through your individual brokerage, you aren't just buying current earnings, you are buying a piece of a $16 billion guaranteed revenue stream. This is why the stock didn't crash alongside other renewable energy names when the market turned hawkish last year. It has a fundamental floor that other companies simply lack. This contrast between the hype of the solar sector and the hard numbers of First Solar's balance sheet is the most important takeaway for anyone trying